That moment the bell rings and the SpaceX IPO is official, your equity status changes entirely. You are no longer holding illiquid, corporate-controlled promises. Your shares transform into freely tradable public stock. Up until now, your vested shares have been locked inside Morgan Stanley Shareworks. If you ever tried to sell them privately, you ran straight into the company's right of first refusal. SpaceX tightly controlled the market, meaning your wealth was effectively trapped on their terms. Once the IPO lockup expires, you finally have the right to move those shares. To do that, you will use a standardized protocol known as the Automated Customer Account Transfer Service, or ACATS. Think of this as the digital plumbing of the financial system. Your shares are converted from book entry records at the transfer agent, moved through an ACATS pipeline, and deposited cleanly into your own personal brokerage account, whether that is Schwab, Fidelity, or elsewhere. Executing this transfer is the mandatory first step. It shifts the burden of wealth management off your former employer's plate and places full control and full responsibility directly into your hands. Once those shares hit your brokerage account, the temptation is obvious. You can finally hit sell to buy a house, diversify your portfolio, or just put cash in the bank. It is immediate, and the transaction itself is risk-free. But the cost of that cash is steep. A direct sale triggers a 20% federal capital gains rate, a 3.8% net investment income tax, plus state taxes. Depending on where you live, you could instantly forfeit a third of your wealth to the IRS. To avoid that hit, high net worth investors rarely sell appreciated assets. Instead, they use asset-backed lending. By pledging your SpaceX shares as collateral, you can borrow the cash you need without triggering a taxable sale. Taken to its logical conclusion, this is the engine behind the buy, borrow, die strategy. You hold the asset, borrow against it to fund your life, and eventually pass the shares to your heirs with a stepped-up tax basis, legally deferring those capital gains forever. There is a catch. Avoiding the tax event means you are taking on systemic leverage risk. You are executing a loan secured by a newly public, highly volatile aerospace stock. If the market turns against you, the math gets ugly. This is the core dilemma of post-IPO wealth. You have to decide which threat you are better equipped to survive, the guaranteed erosion of taxes today or the looming risk of forced liquidation tomorrow. If you decide to borrow, your first option is standard Regulation T margin lending. This is a feature embedded right inside your normal brokerage trading account. Federal rules cap your initial borrowing limit at 50% of the purchase price. However, for a single concentrated stock like SpaceX, many brokerages will impose stricter in-house limits before they hand over any cash. The main advantage of standard margin is flexibility. You can legally use the loan proceeds to buy additional stocks, allowing you to aggressively expand your portfolio without deploying new capital. Keeping that loan active requires strict maintenance. Under FINMA Rule 4210, you must maintain a minimum equity balance, often a rigid 25% of market value. If the SpaceX share price takes a hit, that cushion shrinks. Cross that red line, and the broker issues a margin call, liquidating your shares without consent, locking in losses at the worst moment. Standard margin is built for speed and short-term trading. Relying on it while holding a single, highly concentrated tech stock leaves you entirely exposed to daily market panic. For a safer approach, sophisticated investors turn to a securities-backed line of credit, or SBLOC. This is a specialized portfolio loan managed by a private bank affiliate rather than your broker's active trading desk. To set this up, you have to move your SpaceX shares out of your everyday trading account and lock them into a restricted pledged asset account. Because this is a separate banking relationship, the terms are driven by proprietary risk models. Interest rates are usually negotiated as the secured overnight financing rate plus a spread, and a highly diversified portfolio can unlock greater borrowing capacity. Lenders hate concentration risk. If your entire net worth is tied up in a newly public stock like SpaceX, they will apply a heavy haircut, significantly lowering how much they are willing to lend you against those shares. An SBLOC also comes with strict legal boundaries. These are strictly non-purpose loans, meaning you cannot use the money to buy other securities. And crucially, the debt is due on demand, meaning the bank can call the loan back at their discretion. Ultimately, an SBLOC trades the frictionless speed of a margin account for a more stable credit-based relationship. It shields you from automated daily triggers, giving you breathing room during market volatility. Your choice of loan comes down to your objective. Consider the tactical trader. They need a short-term cash bridge that represents a relatively small percentage of their total net worth. For this profile, standard margin makes sense. As long as they are monitoring the market daily and have the liquid cash ready to wire within 24 hours to cover sudden drops, they can manage the risk. On the other end is the long-term wealth preserver. This investor is looking to fund a major life milestone over several years, like buying a home, paying taxes, or launching a business. For the wealth preserver, the SBLOC is the superior strategy. While margin wins on immediate access and stock buying capability, the SBLOC wins on safety by providing negotiated maintenance cushions that protect the underlying asset. Both tools provide cash, but selecting the wrong instrument for your specific timeline is one of the fastest ways to destroy wealth after an IPO. There is one specific scenario that complicates everything: former employees who exercised incentive stock options before the IPO. If this is you, you likely hold massive alternative minimum tax carry-forward credits. These credits represent a painful double taxation trap. They are frozen on your tax return and cannot be utilized until you generate enough regular capital gains to offset them. The solution is a hybrid strategy. You execute a surgical sale of a specific number of shares to trigger capital gains and unlock those AMT credits, while placing the remainder into an S-block to borrow against. You cannot guess the math on this. Executing this balance requires a specialized CPA. You are trading upfront advisory fees to save millions of dollars in miscalculated tax liabilities on the back end. True post-IPO wealth preservation requires you to separate your desire for cash from the necessity of a taxable sale. By treating debt as a strategic bridge, you can outlast market volatility and keep your equity working for you.